So Zach is a very inspiring leader on the front lines, and Zach, you could introduce yourself as well. But
yeah, of course,
he's one of the co-founders of Startup Bootcamp Africa, and has been on the continent for over 10 years, if I'm not mistaken, Zach. And the Stanford grad, ex-Wall Street, and Zach's here, and I believe he's a really inspiring leader on the frontier, and has played such an influential role for so many entrepreneurs and companies, and has built a track record, really investing in some of the even some unicorns today that are coming out of Africa. So Zach, it's a real pleasure having you here, and we're very interested in learning about the new VC fund that you're launching, Launch Africa. So over to you, and we'll speak soon.
Thank you, Ezzy, and thank you everyone at the Empower Africa team, and thank you, Robert, for a really exceptional presentation on where you see future opportunities across the world in multiple sectors. I'm going to try and keep this as short as possible. I've got a couple of slides that I'll share in a second, but I just wanted to give you some background here. I've been, so as you mentioned, I've lived on several continents. I did most of my studying in engineering in Asia, got my MBA from Stanford in 2004, did my time on Wall Street as an investment banker. So a couple of the slides that Robert showed were personal to me. I was at Lehman Brothers the day they went under, so I know a thing or two about too big to fail. And then moved to Africa in 2010 to watch the World Cup, and realized that there was a huge gap in the market from a VC standpoint. So although private equity on the continent is quite well established, venture capital as an asset class did not exist in 2010, 2011. So when I came here to South Africa, the total amount of VC activity on the continent was barely over $20 million across the entire continent. That number is sitting at more than $2.5 billion as of last year. So it's the fastest growing region in the world from a growth and VC perspective. So I built the first accelerator in Africa with Barclays called Tech Lab Africa, which became Techstars. I then co-ran Startup Bootcamp, which is the largest tech accelerator in the world outside of the US. In the US, it's Y Combinator, as most of you are aware. And over the course of the next 4 years, we saw almost 4,000 of the top tech startups in Africa through our accelerator program. The continent now has more than 60 world-class accelerators, and several African technology startups are now household names globally, the likes of Flutterwave, Andela, Kuda Bank, M-Pesa, Empower, and several other companies in financial services, insurance, retail, e-commerce, etc. So this past quarter alone, in fact, the past 2 months alone, we've seen 2 major unicorns come out of Africa. So it's very important to understand the concept of venture building and not just raising a fund. Anyone can raise money, but working with entrepreneurs from the ground up and helping them build their MVPs, their prototypes, help them with POCs, proof of concepts, and pilots with large corporates is a lot of hard work and grafting. And our team have done an exceptional job over the last 10 years. At the heels of which we last year launched Africa's first seed VC fund that covers the entire continent from Egypt all the way down to South Africa. Multiple sectors from fintech to insurtech, agri-tech, health tech, logistics, supply chain, and mobility, the common theme being tech-enabled, and CapEx and asset light. Prior to launching Launch Africa, I've also been one of the most active angels on the continent, and the current fund is a $20 million fund, of which we've already raised $16 million. And most of our LPs are prominent high net worth individuals and C-suite executives all over the world. And we've done just under $9 million in investments so far. So I'm going to share a screen really quick to go over some of the sort of high level. Right. So Launch Africa Ventures is a frontier Pan-African fund. It's the first fund in Africa that solves a significant funding gap between seed and Series A funding on the continent. As I mentioned earlier, the amount of activity has grown by leaps and bounds. Up until 6 or 7 years ago, there wasn't really a market for Series A and Series B VC funds on the continent. We now have more than 200 VC funds on the continent. The bulk of VC activity in Africa tends to be late stage investments, so Series A, B, C, D, and beyond. There's very little investment that happens at the friends and family stage and angel stage. And that's where the biggest arbitrage happens from a valuation standpoint. So at Series A, and I assume most people on this call know what these terms are, so I'm just going to run with it. Most Series A and Series B valuations on the continent are on the same market value as your counterparts in the US, Europe, and Asia. So you're looking at average Series A valuations of between $20 million pre-money to as high as $100 million pre-money. And at Series B, valuations start at about $50 million and go all the way up to $200 million. And recently, given what we've seen, as high as $500 million. The big discrepancy from an African VC perspective is at seed. And it's not because there are any discrepancies in product market fit or problem solution fit with these companies. It's just that there's not enough understanding of risk capital, and the only players until now have been friends and family and small angel groups. So there is an arbitrage in the seed investing space that accelerators like Y Combinator, Techstar, Startup Bootcamp, 500 Startups, etc., Plug and Play, Founders Factory, Founders Institute, etc., are looking to fill to create more investment-ready companies and to shorten the time it takes to get a company to an institutional round of funding down to 6 to 12 months versus what normally takes them 3 to 4 years. So we are, and the one thing I want to add very quickly up front is business models in Africa don't necessarily follow the same trends as the rest of the developed world. I hate to use the word developed versus developing, I'm just going to say it just once. B2C business models are very hard to scale in Africa. And it's not because they don't work because the demographic, is just that customer purchasing powers and the cost of acquiring customers in Africa is very large. What does work in Africa is B2B business models and B2B2C business models. So the key aspect here is how do you solve for distribution? And you solve for distribution in markets like South Africa, Nigeria, Egypt, the 4 horsemen of Africa, if you look at a country distribution, through insurance companies, banks, retailers, and telcos. So if you're able to solve a problem for those 4 sectors, broad sectors, and their clients, you're able to solve distribution. And the most successful technology ventures in Africa all have B2B or B2B2C solutions. And that's a key facet of our fund, is we only invest in companies with those sorts of business models with POCs, pilots, and recurring revenue from large corporate clients. We invest primarily in companies that are graduates of world-class accelerators. I happen to be the founder of one of them, and a lot of similar world-class accelerators have cropped up in Africa in the last 5 years after our experience there. We lead, for the most part, seed rounds across Africa. We invest up to $200,000 into early stage, post-accelerator, post-MVP tech ventures. And one of the biggest challenges in VC, not just in Africa, but globally, has always been liquidity in sort of frontier markets. So traditionally, the 3 major routes for liquidity would always just be an IPO, very far and few between, or trade sales. And those trade sales have normally been in emerging markets, corporate M&A, which I called vertical M&A. So you have a large bank, a large insurer, a large telco that ends up buying you. But the reasons for buying you and the multiples they pay tend to be way below average, right? Because large corporates tend to buy startups, at least in emerging markets, out of fear of the unknown versus having a real strategic rationale for buying them. What's happening a lot lately is horizontal M&A, where you have larger fintechs buying smaller fintechs, larger online marketplaces buying small e-commerce companies. So you have ex-founders buying smaller companies because they understand how to scale and grow a startup, and those multiples tend to be a lot higher. But even in those cases, the time it takes to achieve returns from a liquidity standpoint ranges from 7 years at best to realistically 10 to 12 years, and if not longer, which is why most of the LPs in traditional VC funds tend to be DFIs, aka development finance institutions like the IFC, the African Development Bank, CDC, Proparco, FMO, all the big European and US DFIs that don't have a liquidity constraint from a timing perspective. In our fund is a 5 to 7 year fund. Almost all our LPs, we have about 95 LPs in our fund, are retail investors like yourselves. So individuals doing investments of as little as $50,000 all the way up to $3 million. It's retail capital, and a big part of our exit strategy is to look at it exiting our investments through secondaries. I'm sure most of you know what secondaries are, but for those that don't, it's the ability to invest early in a startup at the seed stage. And because you lead a round as a fund, you get priority from an optionality perspective to sell your stakes at future rounds of funding to incoming investors to sort of that look at clearing cap tables and reducing or minimizing founder dilution. Almost every major Series B and C round and several Series A rounds for prominent tech startups in Africa have between 5 to 25% of the round going towards secondaries, and that's a key avenue for us to create liquidity in our fund. So yeah, I've run 2 funds before this. My partner Junaid, who was the chief investment officer of the African Development Bank for several years, has run 2 funds before this. This is our first fund together, and our sort of vision is to become the premier seed fund on the African continent. We've already made 40 investments across Africa. You can see all of that in the link that I've sent. And yeah, my last fund had an IRR of 45% cash on cash. Junaid's last fund had an IRR of 53%. We're targeting an IRR of between 25 to 40% at the very minimum for this fund. And yeah, we allow all our LPs in the fund to co-invest alongside us completely for free. No carry, no management fees on co-investments. It's something that very few funds allow their LPs to do. We allow it simply because it's one of the quickest and easiest ways to capitalize early stage investment in frontier markets. Yeah, we've raised $16 million so far. We've deployed 9 into 40 companies, and we're looking, and there's a small window of opportunity over the next 2 months for further LPs into our fund. And I am happy to take any questions.
Thank you very much, Zach. No, very impressive. And again, it's like you said, it wasn't existent. I think we have 2 leaders over here that were very early on. Robert on the impact investing front, 25 years early, and you 10 years really positioning yourself and building your track record until now. And it's really encouraging to see the investment going into the VC space and the real success in the tech sector in Africa. And I think we're just at the beginning of a whole amazing era on that front. And congratulations to the unicorns past month that emerged on the continent. So
I could probably share one quick example. I know this is not me being overly bombastic. You know, we 2 years ago, we accelerated one of Africa's top digital banks. At the time, was a microfinance bank with a microfinance license. They went to our accelerator. They spent 3 months with us. We helped them with everything from CRM to legal to IP to marketing to their business model to growth hacking. We had an 8% stake in them for a $20,000 investment because they went through our accelerator. That company is now Africa's national bank. They've got 1 million users. They're based in Nigeria. They've just finished their Series B round led by Valor Ventures, which is the world's top fintech fund, backed by Peter Thiel. I'm sure everyone here knows who Peter Thiel is. And Europe's top fintech fund, Target Global. Their valuation currently is $500 million, and they're a 2-year-old company. Mm-hmm. So that's just one example. When people say that there isn't the opportunity to make massive returns in VC in Africa, they just aren't aware of the huge opportunity. So that's just one example of a company that's now close to being a unicorn, and 2 years ago was not even worth $1 million, right? So. And there are several other examples of companies like that. Financial services, fintech, retail tech, mobility, logistics, and health tech tend to dominate in Africa for obvious reasons. And to Robert's point earlier, that the beauty of investing in tech-enabled businesses in Africa is you create huge impact in sectors like healthcare, food and water security, agriculture, financial service, financial inclusion, insurance, just by making things accessible to people. So you can truly have a triple bottom line when you invest in tech in Africa and make a lot of money. So on top of that, yeah, happy to take questions for a few minutes.
Amazing. So we have a question over here from Daniel D. Ryan. How long are you aiming for investment exits?
Yeah, so like I said earlier, usually companies do between 5 to 7 rounds of financing before an exit. So you typically have a seed round, a pre-seed round, a seed round, a seed extension, a Series A, an A extension, a B, a C. You can go as high as 7 to 8 rounds before you ultimately exit. When we invest at seed, we have 4 to 5 opportunities to exit at every successive subsequent price round. That's the reason why our fund has a life of up to 7 years and is not a 12 to 15-year fund like most traditional VC funds. But we have that privilege and are given the optionality to exist because we've been building ventures in Africa for the last 10 years. So there's a huge amount of credibility that founders place with us. In exchange, they give us that opportunity to take money off the table at future rounds. Most people never get that opportunity, but we do, because we built a significant amount of ventures in Africa over the last 10 years. And our LPs love that because they get to piggyback of that without having to do much, right? So it's sort of a sweetheart deal for our LPs. So.
No, it's there's a lot of money I think on the sidelines, really looking at the tech space and really looking at all the innovation that's taking place, and having someone, I think, like you, that's also identifying the opportunities and also helping to nurture them. Because it's not just about allocating the capital, like you're mentioning. It's really working with the founders and getting their company to the next level and supporting the exit or the next round. I think there's a tremendous amount of value creation already now in the tech sector. Power Africa is all about human ingenuity and people creating significant value through their talents rather than so much investment going into the extractive mineral space. And we really are. I was speaking to major investors here in the United States the other day, and I was speaking about the unicorns that just emerged this past couple of months in Africa. And I said, how long does it take? In 2-3 years, you got $1 billion of value creation, from these founders and new companies being formed on the continent. How long will it take you to extract those minerals from the ground at $2 billion? So I think this is, again, we have real innovators, entrepreneurs on the continent solving real problems and that are creating significant value. And I encourage more people to be engaged in the tech space and to really touch base with Zach and to learn more. And if there's interest, then of course I look at participating in Launch Africa. I think it's a fascinating fund that's being launched. And we have 2 requests. Let me see if we want to have some people on. Yes. Okay. Yes. Aya, you want to come on stage? Not to give on. Yes.
I think there were a couple of questions about ESG strategy and managing impact. I'm happy to talk about that very briefly if there's time. But what we have our next speaker, so I'm happy to just.
I think we can go for a couple minutes. Aya, you have a question you want to mention?
Yes, actually, yes. Thank you so much. I actually just have a little question regarding B2C models. First of all, thank you, Zach, and thank you, Izzy, again. I learned a lot from this session. So regarding B2C models, as you said,
just before you speak, would you like to introduce yourself for a second?
Yeah, sure. I just thought, the time does not happen, but all right. So my name is Aya. I am based in Casablanca, Morocco. I was in venture capital before with George Capital, specialized in Middle East and Africa. Currently, I'm an innovation finance consultant. I work mainly in the UK, but I still advise, GIZ on their investments, especially in AgTech in Africa. Already had a short discussion, not a discussion, but we had a presented to Launch Africa before. I'm not sure if you remember, Zach, it was in AgTech like a couple of months ago. So many interesting things. My question really is on the B2C models, because I do agree with you regarding the B2C. It does not work a lot in Africa. So most VC funds, what I have personally noticed, that they really go towards the B2B, the B2B2C models. According to your experience, however, what do you think is the future for these kind of models? Do you think that B2C might work at a certain point of time? Does it need support from other agencies for it to work? As we see, for example, a lot of startups now that arise that go B2C, but unfortunately they cannot raise money at any time. So yeah, thank you.
Yeah, no, absolutely. That's a great question. Listen, I'm not saying that B2C doesn't work. There are a few good examples of B2C businesses in Africa that work. It just requires, it just takes a lot of capital to scale that, right? So one of the prerequisites of a B2C business model is you have to be able to acquire that end customer in a very cost-effective manner, right? So if you're spending $5 acquiring a customer in Kenya or Nigeria or in Ghana, how much are you going to spend or how much are you going to extract from a lifetime value from that one customer? And more importantly, what is the likelihood of that one customer that you've acquired referring you to multiple customers? So AKA the viral coefficient of that one customer. In the US and in certain markets like China and India, that number can be very high because the consumer purchasing power and the sophistication of these customers is a lot more. There are more for viral referrals. I mean, these are metrics that most VCs in Africa and emerging markets don't look at, because unfortunately, most VC funds on the continent and in emerging markets are run by private equity folks or folks with CAs and CFAs. But they look at traditional metrics like EBITDA and break-evens, which is so counterintuitive to venture, right? So you should be looking at growth versus churn versus take rate. So if you're selling a product to a customer, how much more can you sell to them before they drop off because you're being too aggressive? Like, these are things that only venture builders and accelerators understand, because you go into the heart and mind of your customers. And that doesn't come from getting an MBA or from, being good at spreadsheets, right? So that's why B2C models can work, but you have to really have an unfair advantage in acquiring customers. Then it absolutely works. Or you have to have a shitload of capital to acquire them. Now, in San Francisco, you can raise $10 million on an idea, provided you tell a good story. Good luck raising 10 million shillings in Kenya to acquire in a pre-seed round. So that's the reason why you have to go and prostrate before the insurance companies, the banks, the telcos, and say, hey, Safaricom in Kenya, we could market a product that could give you a lot more customers or offer a lot more benefits to your customers. How about a license agreement? And then once you acquire those customers, then you can slowly pivot away from B2B directly to B2C. But the first 2 to 3 years of your growth, you have to go and work with the corporates. And I've learned this the hard way. It's been 10 years of me doing this, and you unfortunately have to not grease the palms, but you have to go and knock on the doors of all the big corporates. And then eventually they start working with you and you acquire the customers for them. So,
Gotcha.
it's a long answer to a short question, but very, very relevant.
Awesome. Thank you so much, Aya, and thank you, Zach, for explaining that. So I think we're going to go back to, it's already 12:30, and we're going to go back to the networking session. And I encourage everybody to stop by and see Zach, whoever's interested in the Launch Africa, and to stop by also with Robert Rubenstein. Thank you. Have a beautiful day, and thank you again all for coming. Open your mics and jump around and enjoy the networking. God bless.